All right, good afternoon, and thanks for joining the Energy Market Update. A special welcome to our channel partners able to make it this month. That's me on the left in the picture. We got a trusty legal disclaimer on the right, and then our agenda as usual, natural gas fundamentals, market news, weather, and then end up with market data. So taking a look at natural gas fundamentals quickly, this is a growing story of importance, especially for the Northeast and Mid-Atlantic regions as we are starting to approach winter, is the storage. So we had estimates for storage 63 at 66 this week. It came out at 64. So no surprises in the daily market for the storage number for gas. However, and this is a big however, huge story developing compared to the 5 year average. The 20 or 20 and above clip a week that we've been losing this cushion continues. Last week we were at 203 above the 5 year average. This year we're at 100. This week we're at 183 above the 5 year average. So losing 20 exactly this past week. Over the past several weeks, we've gone down from 360 surplus to now below 200. So if we keep seeing this shrink, especially as we go through fall into the winter, that's really going to build upward pressure on prices for volatility. So taking a look at that in the picture, we see it starting to hook down with the green line here with the arrow. And the upcoming injection is looking at 88 to 108, but these estimates are still very early, so we're going to keep an eye on that. One of the big stories is, how much production can we get out of the ground? But then how much of that production are we actually keeping here, not shipping to other countries via LNG? And if we look at the forecast from where the red arrow is going to the blue, it's pretty flat for the actual production of natural gas here in the US. And just kind of looking at it under a microscope a little bit more, you see 2022 is the lower line, 2023, the production for natural gas, a little bit higher, but nothing significant. And we're comparing that to the great increases that we're seeing for the LNG exports. We actually just clipped 15 BCF per day. So those are continuing to grow, with some forecasts in the next several years having those up to maybe 28 to 30 BCF leaving our shores. So net, we're going to be down supply. Less supply usually contributes to upward pressure on pricing. And we know why is it leaving the US? Because prices around the world are much higher, whether it's the national balancing point for the UK, the tidal transfer facility used for the EU, or the Japan-Korean marker used over in Asia. This is what we saw last month for any channel partners on the call. So this was the August look at the risk going up and down. This is, again, only NYMEX, so that's ERAT Louisiana gas, before it adds any of the basis to any of our geographic locations. But this way of looking at the graph, by applying the black and red arrows or marking it up with a client, whether on PowerPoint or when sitting with them, is to show what is the risk moving forward of prices moving up or down. So the risk of prices moving up is the black arrow, the risk of prices moving down is the red. And as you can clearly see, black arrow much bigger than the red. So this was the August forecast. And here is the updated September forecast. And we're seeing those outside years. The red shrunk a little bit, and the further outside part, indicated by the yellow arrow, shows that it actually grew for risk of prices going even higher into the future. So that's what we want to make sure we explain to clients. This type of thinking we want to apply to the graphs that we're going to see at the end of the presentation to help really get that visual point across. Save a couple mils, save a couple cents to lose 10 to 20 mils on the other side. Is that worth the risk? Should we take a piece of that off the table by fixing in with the hybrid solution? Or taking a look at market news, there were so many stories about EVs this past week, with the auto workers strike going on possibly, and how bad that's going to get in the US. So just trying to get in a few stories here that were really pertinent to what we're talking about. So one story, Volkswagen laying off a bunch of workers, doing what they called cratering demand for EVs. Now that's because subsidies have been disappearing for both the sellers and the buyers. Now this isn't in the US, and we still have the IRA hanging around, giving plenty of free money out for a lot of these projects from taxes, but that money's still there. But in other places where the money's disappearing, the free money's disappearing as subsidies, we're seeing these things fall off. So it's going to be a big question over the next two stories, whether this gets mandated at a state and federal level that people have to use EVs or not, and how much money will be continue to push towards that. Another big story we've talked about over the past couple months is GM and Ford, the CEOs came out during their shareholder meetings and said, you know what, we can't do this full clean green push for EVs. We need to rely more on our hybrids and also our gas powered line of cars that we're putting out there, because simply it's not making economic sense right now for it to move forward. So that was a big change from some of the big US suppliers. Well, now the UAW, United Auto Workers Union, might be going on strike, and some of that is linked to the issues surrounding the EV manufacturing and put be going into as much today as, I mean, Ford and GM are being looked at, especially Ford, for a plant they're opening in possibly Michigan that's going to be for the batteries for the EVs. That is basically backed by a Chinese Communist Party company. So that's irked a lot of people in Congress. So we need to see how that story materializes. Lastly, the EU is investigating a bunch of cheap EVs coming in from China, possibly going to enact tariffs to keep those out of their market. China obviously not very happy about that, especially when China holds the keys to a lot of these rare minerals that may be needed to go into the production. So a lot of uncertainty. The EV market is our takeaway. What path moves forward? If we have state and federal mandates, we're going to have a lot quicker push to go to EV. If the car market is left up to the free market to work itself out, it's going to be a longer period of adoption. But the risk is there. We have seen proposed rules and regulations by both the Transportation Authority appointed by the Biden administration, the EPA, and the DOE, trying to make this law a push, kind of like they did in California recently, that by a certain year, no more gas cars sold in the state. Well, on that story, that's continuing to develop. The House of Representatives actually just voted against that being allowed at a state level. We'll see how that story materializes. But again, a lot of uncertainty, changes cost money. And the last piece of that is the electrification. As these EVs come online, especially in concentrated places like cities, it's going to send demand through the roof. New York talked about all the electrification they've been doing in NISO, and they're saying, I mean, it might triple or quadruple the demand on the grid in the coming years. What does more demand do for prices? Usually sends them up. So want to make sure clients are looking at those outside years. Sticking with the EV story and showing how delicate of a balance this is moving forward, and it's not simple as just trading one car out for another for actual use. Department of Energy Secretary Granholm just had the cops called on her. Her and her team were blocking a charger from people trying to access it. Now, the point of this whole trip was to show that they could drive from North Carolina to Tennessee on a 4-day road trip and show all the great things that EVs could do. What was happening behind the scenes was this was an intricately, painstakingly planned trip, going from station to station with a scout team to make sure that they were clear so they could roll in and roll out and look good for the cameras, because of all the money that's being pushed towards EVs. Again, whether you like it or not, that's what's happening. This though showed the example. They ran into a problem in Georgia, the huge lines for the EVs. They blocked off with one of their staff's gas-powered cars an EV station. That's why the cops are called on her, because one family claimed they had a kid in the car and they needed AC and couldn't get it from the EVs. But this is piling on specifically for Granholm. She's been asked to resign by several conservative groups and by several politicians right now because of constant ethical lapses. She's been caught and admitted to lying under oath to Congress about stock ownership in linked clean energy. So we're not sure what her future will be, but if she stays in office, we can just expect she's going to follow the same route of going very clean push by any means necessary going forward. And really, the big thing we're looking for is, will this be mandated to switch? Will it get pushed back? What will the next election for president do? If we flip Republican, it'll probably pump the brakes on this. If it stays blue, it'll probably only accelerate what's been going on for changes currently. And if those changes continue, demand's going to go up, and it'd be a great reason to explore the outside years with clients sooner than later, especially where current markets are. Another story going out, this really just kind of goes with the government whole push towards clean energy. Usually, as the White House flips from red to blue or blue to red, all the agencies that they appoint usually take their view. Energy, though, usually was the Department of Energy, FERC, EPA, the usual suspects. Underneath the Biden administration, it's almost been every facet of government that has going after fossil fuels and supporting the clean energy push. Right now, the biggest farm bill in U.S. farm bill in the country is being held up because people in the farming industry want it reallocated to actual problems plaguing the industry right now. The top negotiator, who's a Democrat, Stabenow, is saying, you know what, I'm not going to allocate any of the 20 billion I have for climate-friendly farming to any of the other problems. So right now it's a stalemate. Contract's actually supposed to expire in this month of September, and she's hoping that she can get it done with votes by December. But our takeaway is really just showing how entrenched the ideology of the clean push has been permeated to all the different agencies, and we expect that to stay the same. Again, it's not whether you like it or not, it's just what do we expect coming down the road? How will that impact prices? So more money going against fossil fuels, more being pushed towards changes. Changes cost money. So we expect this pattern to continue and that risk to continue to build for our outside years, which we're starting to see reflected in some of our markets more than others. Lastly, one of the stories some clients are coming out with is saying, oh, maybe we're all set. This is the silver bullet for the clean energy supply chain problems. Is we just found a huge lithium deposit, the Thacker Pass project in Nevada. So that's all well and good. It's a great thing to know that the U.S. has some here. However, that is just the start because lithium mines basically cause irreparable damage to the earth. So it might be the environmentalists going against the environmentalists on this one. What's worse for the earth? I mean, the emissions are actually ripping apart the earth. So that just starts with getting it out of the ground. But then more importantly, the economics surrounding it, which is the refining and the manufacturing. We can't do it economically here in the U.S. unless even larger subsidies on top of the hundreds of billions of dollars already being pushed towards this are allocated to it. So more than likely, it's going to need to be shipped on an oil tanker somewhere else in the world to be manufactured, possibly by coal plants, like if it goes to China, to make these parts as it moves forward. And then lastly, as this all came out, the announcement about Thacker Pass is the Biden administration. It's an interagency group, but Department of the Interior, Deb Haaland is one of the people leading it, said that they were going to looking at a 50-year mining ban in northern New Mexico. So different states, but the bans have kind of been flying lately. I think it's been the past 6 or 8 weeks we've talked about the Biden administration banning one place or another, whether it was Alaska, the Gulf of Mexico, from drilling of natural gas and oil, but now mining being on top of that, which natural gas and oil are included in this 50-year proposal of ban in New Mexico. They are currently working to redo the entire mining policy of the U.S., so we don't know if this is going to spill into any other states. But again, if less supply, we're going to have one less thing to help us out. Now, going further on that with China, we know that the Chinese and several Southeast Asian countries were just found guilty of basically importing Chinese solar panels, but just rubber stamping their country's name to avoid tariffs placed on China by the U.S. for environmental and humanitarian crimes or reasons, however you want to put that. But either way, that tariff would put a lot of projects underwater if they were to move forward. That's why in February of 22, when this investigation had come out into the solar panels being imported from these Southeast Asian countries, it was such a big deal. Basically, the entire solar industry grinded to a halt until June of 22, when President Biden gave a waiver that expires very soon. Next June of 2024, that waiver expires. So going into that, will our relationship with China get better or worse? Hopefully it gets better. Currently, things are not going well, though. We recently had China flying over at least 150 warplanes toward Taiwan, with some violating the airspace, which they don't recognize. Idea of an invasion or a lesser conflict is starting to heighten tensions. More importantly, which isn't really screaming across the news cycle, but very important to our industry, is China just stopped exporting 2 rare critical minerals needed for semiconductor chips in August. So the U.S. and China has been publicly fighting about semiconductor chips used in computers, cell phones, and such. China just stopped exporting 2 of those minerals in August after putting some curbs in place to watch overseas exports. And they are producing 80% of the world's gallium and 60% of the germanium. So Again, this is a big part of the supply chain where energy independence of leaving behind fossil fuels and moving towards clean could run into some huge roadblocks if countries decide to just cut off supply. And this is exactly what China just did when it comes to semiconductor chips, which we're publicly fighting about. We haven't fought about EVs yet, but now we have the EU kind of fighting with China about the EVs. So hopefully that doesn't become a worse problem. But that would stop us in our tracks, really, because we wouldn't be able to complete a lot of the projects or forecasts that are currently out of how green we're going to go, how fast. Taking a look at the Russia-Ukraine issue that started off all these supply chain issues really around the world when this kicked off and put us in a new place. We have President Zelensky visiting the Pentagon, Congress, the president, trying to shore up more military and financial support. Meanwhile, Russia has been the easy walk into Ukraine, obviously didn't go the way they thought. They're now pulling troops away from other countries' borders to try to put them towards the use in the Ukraine to bolster their war efforts. So either way, it doesn't look like there's a quick resolution coming to this, and it should be continuing for a while. Again, reason to look at those outside years for clients, because if something goes wrong, like China cuts off minerals for chips, what happens if they cut off supply for EVs? What happens if China ends up backing Russia more, which could be a bigger problem that we saw come out last week, a report that China and Russia's trade has increased to the highest level it's ever been since the start of the Ukraine-Russia. Other than the actual energy, we know the aggressive net zero goals are out there. That's why taking a look at fixed data with clients is a great strategy. States want to do this quicker at a higher amount. And this is really politicians. These aren't the engineers and stuff behind the grid saying this is doable, this is not. They're throwing numbers, aiming for the best, but it's causing a lot of issues. But locking in your fixed data can help you prevent having to pay that during the term of a contract. We take a look at what's actually being used in the U.S. for fuel sources and take a look at the black and green lines. Purple and green lines for wind and solar. We don't see those going straight up in the air. They're going up slightly as you go into the forecast period, but we're not making those jumps by generation for renewables that you might think that everything's going swimmingly just looking at headlines. So we've seen these before, Q3 of 22 and Q4 of 22, and we see most of our major markets a little bit up, a little bit down, actually year over year. And now looking at the beginning of this year for renewable generation coming out, PJM, NYISO, ICE in New England, not too much of a change right there. PJM was up, less than 1% for Q1. It was down just over 0.5% for Q2. ERCOT was up 5 for Q1, but down just below 5 for Q2. So we're not really making the leaps and bounds of going renewable just yet. Just a touch of reality from what's seeing out there in the news cycle. Move over to capacity. We know that PJM capacity is still held up. Capacity pass-through still being a strong option for both our PJM and ICE in New England clients, unless they have inelastic demand, meaning they can't turn around their energy at all, say as a water park on a really hot day, a rock crusher that gets appointments, or car crusher, or a medical device facility that needs to stay at an ambient temperature no matter what the weather is outside. But most of our clients, pretty good candidate for capacity pass-through, since subsidized assets are going to be allowed to participate in these capacity auctions, which is going to keep a lid on prices. We know that some premium is going to be put into the PJM fixed capacity because, yet again, the auction was pushed off by another year that was supposed to run this past June, and it's been kicked to at least probably June of 2024. In ICE in New England, over the next capacity auctions, more and more subsidized assets are going to be allowed to participate, which should keep a lid on prices, making capacity pass-through a strong option. And this is one of the last meetings really to highlight the signing up for the peak demand notification. This is something you can sell throughout the year for clients, along with the capacity pass-through product. We'll have the final numbers on the next meeting that come out. We've called all the days and hours so far for both ICE in New England and PJM. Taking a look at weather, this is the old forecast for September, October, November. Really just want to keep it here for comparison. As you see, most of the country, except in the middle north, right, leaning or likely above average through November. And this is one of the things that can happen too. It stays hot for a while and then it can quickly flip, We've heard a lot about El Nino being around after leaving La Nina. But as we take a look at October, November, December forecast, we see that equal chances of it could be hot, could be cold, really spreading throughout most of the country. And then just the leaning above, really capturing most of the country, with really only Maine being likely above average temperatures. Now taking a look at the winter forecast, and again, these last two forecasts are fresh off the presses. They just got printed out today, so we're waiting to see how the market reacts to them. So just coming out today, the December, January, February, we see that most everything on the southern part of the country, equal chances 50-50. And then as you get through PJM, it's really kind of just leaning above. It's really only that northeast corner for ice in New England that looks likely above average. However, blocking events that when you get the 3-4 day storms could easily blow that heat off the northeast into the Atlantic, and all of a sudden you have a cold shot, and that's when we see prices spike the most. So trying to bet on how many storms are going to have this winter is a really tough thing to do. With prices being around 52-week lows, great place to pick it up for ice in New England, PJM, NYISO. So again, we left La Nina on the right. We are in El Nino. A lot of people are talking about that. But when people take a look at analog years, looking at historically similar years, if you look at just the El Nino, it says, okay, warmer. But if you look at some of the more in the weeds details around weather forecasts and find analog years, it kind of breaks out to a 50-50 or 60-40 split of whether it's going to be warm to cold. And both the Farmer's Almanac and the Old Farmer's Almanac have a very different outlook on the coming winter. As you can see, cold and snowy and pretty cold for the Farmer's Almanac, and the Old Farmer's Almanac that recently published as well, calling for cold and snowy for most of the country. But for the Northeast, mildly snowy compared to the rest, where that might link a little bit to the above average forecast we saw. Taking a look at the 7-day forecast, no expected peak notifications going out for ice in New England or PJM. Temps kind of cooling off, really getting into those fall temps here, while staying basically hitting a high above 100 for at least real feel for Texas for the coming week. So still staying hot down there. Will they have enough time for changes before the winter? So in this market, I mean, some people can understand great value picking it up right now, but if not, load following Black on Index is a great solution, at least locking in that fixed data so you can reach out to clients as some of these stories materialize. Taking a look at market data. So ice in New England, not too much movement this week. A little bit came off of October, November, December, really, that we just see what's right in front of us because we think, the forecast, we can at least read into that. And balance of the year, looking at now October to December of 23 was off 2 mils week to week, established a new 52-week low yesterday. But this is not a significant 52-week low, right? If we look at the short-term graph, we're just kind of bouncing around the bottom. Haven't really gone too much lower than we were a couple months ago. And we're really worried about prices spiking up, which we're going to see that happen in ERCOT because their summer is the dangerous period, and August did explode for pricing, and now those forward years are all up. So saving a mil for a month or two to lose on 24 or 36 months of a term, that's what we want to help clients understand. Taking a look at ice in New England calendar year 24, from those from last week, these might look a little bit different from those channel partners joining from a month ago. These charts are going to start to change rapidly because if we look at the long-term graph, we're starting to lose the highs of last year as we move through. So this box is changing, which means the numbers on the y-axis changing so it doesn't reach as high. And so it's just making the shape look different, same information that's sitting in front of you. But 24 reacting a different way. That risk hasn't come off, right? If we take a look at what's been happening since the crash, the price has kind of steadily been going up with a little bit of rallies and drops along the way and kind of moving flat over the past couple weeks. Taking a look at gas for ice in New England, off 3 cents week to week for the balance of this year. So that's only the months of October, November, December, a new 52-week low. And looking at calendar year 24 was off 1 cent week to week, still hanging out near the low. But again, we've kind of been cruising along the bottom, and we're worried about any of these bullish stories really taking off. PJM Not too much changes this week for electricity. This graph looks pretty similar to last week. Winter's still at risk. They're trading at about, they're less than half the what they were last November. Taking a look at balance of the year for PJM Western Hub was off a half mil week to week, still closer to the low, still hanging around the bottoms, still can buy it below the 52-week average. Great spot to buy. PJM calendar year 24 was flat week to week, but still closer to the 52-week low, almost getting to that midpoint between the low and the 52-week average. And that average is going to change as the old highs start to disappear. So this is going to look different to clients. So keep that in mind. Taking a look at PJM gas was off 2 cents week to week to establish the new 52-week low. And again, this is only going to the end of the year, those 3 months, where calendar year 24 for PJM gas off a half cent week to week, still hanging out near the low, but not dropping as much in the future. On the other hand, this is the example. ERCOT, it has the summer that takes off, winter for ICE New England, NYISO, PJM. ERCOT is back up. So the price for August 24 is now above the 10 cents at like 10.3 right now. That was down to like 7.7 in the past several weeks. So that's exploded, and it's also pushed on to August 25, as you can see. And that's what we're worried about, is not having clients be aware of this and then prices turn around. So as we take a look at ERCOT Houston for the balance of this year, that's above the 52-week average now, after being up a mil week to week. And looking at calendar year 24, right, this chart looks a whole lot different than everything else. We see that prices have gone up a lot. Now this is also the old highs disappearing. So this piece is gone from the long-term graph. So that drops down this thing. That's the new high. And then the current pricing is getting very close to it. So this is the only chart really. This is what we want to make sure clients, how volatile this market can be. And it can change on a dime. We start getting early snow, the cold weather forecast starts coming true, or any of the problems with the rules or regulations come through, these prices really could pop very quickly, very reasonable spot. And use the wholesale tracker to show how low prices have been in the past, because they usually don't sell below that. And that's why you can say the bottom versus the top of where prices are going. Taking a look at Houston Ship Channel for ERCOT gas was off 1 cent week to week, still close to that 52-week low for balance of the year. And Houston Ship Channel for ERCOT gas off a half cent week to week, still kind of hanging towards the low. And we know Houston Ship Channel, Henry Hub are right next to each other, so pretty similar prices in chart. They both being off a half cent week to week, just above the low. But as we move around the country, the basis is the biggest, NYISO in New England. It's a lot smaller than it was last fall into winter, although it has widened out a touch lately. Where on the other hand, PJM, NYISO gas, what a great time to buy, because that red line for PJM gas ducked even below the gray for a short bit, but now it's pretty much just at the Henry Hub pricing. So at least lock in that basis. Great way to pick that up if you want to wait a little bit, hoping the gas comes off for another month or two. But things, again, could turn around very quickly. Taking a look at ICE New England going out into the future, we had 24 through 2027 up around a half a mil. Outer years really didn't do anything. And Algonquin was off a touch for 24, but all the outside years were actually up. And that's what we're talking about, looking at those further terms with clients. And that's what we want to apply to this chart with how high or low can we go from here. So first of all, you have President Biden taking office. Then you have really the start of the Ukraine-Russia invasion here. So maybe if you use this as the low level of where prices could go from now, if we start talking confidence intervals, 95, 98, but more simple way to bring it to a client, you draw a line here, how high prices can go out of recent where we've been here. So the space between the top line is a whole lot bigger than the space between the lower line. And that's what clients are putting at risk by not deciding to at least take a piece of that risk off the table. So that's what we want to be applying to all these line graphs. Similar story for ICE New England gas. Taking a look at PJM going out into the future, 24 in the outer years, really not too much movement over the past week. And again, the gray bar is the last price the full year of 2023 traded on, 12/28/2022. So basically the price just before the year start, right? And on all these graphs, the gray bar has been towering. And again, we want to apply the upside downside risk to PJM electricity and the gas. But again, getting back to that gray bar point, ERCOT Houston, all these outside years used to be a lot lower in comparison to the gray bar. Now we have calendar year 24, almost to the point where 23 was. So again, this shows all those outside years. This could very quickly happen to ICE in New England, to PJM, to NYISO. It could jump right back up, and it has in ERCOT. So taking advantage sooner than later, instead of having the regret, at least getting that in front of clients to say, hey, we looked at it. I understood you had to wait, but at least get that fixed data locked in, because you can speed up pricing requests and you can get things done quicker instead of chasing the market for a longer period of time. And lastly, the Houston Ship Channel calendar. Houston Ship Channel calendar year prices. Very interesting chart, very much tied to the LNG story going forward. We're seeing that leave the shores, that putting upward pressure on those outside years. And we actually have 26 above the last price of 23 was. And again, we want to apply what is the risk going up or down. As we see here, calendar year 24 is almost at the last price of calendar year 23, right before January of 23 started. So that's what we're worried about also for those outside years. Will there be any more excitement? And we want to apply that to all of our markets. So in conclusion, a lot of our points don't change because of where we are. We're kind of waiting to see how these regulations and rules move forward, and basically what's coming for the winter for the Northeast and Mid-Atlantic areas. So we want to be evaluating how high or low the market can go from here. So that's the example with the arrows to apply to the line graphs or bar graphs. Want to evaluate the longer terms because risk continues to build on those outside years. Ahead of time, we want to take a look at what's the risk and how likely that is to happen. Most expensive months are ICE New England and PJM. So people are going to be leaving summer rates into winter rates from utilities. So a 12-month rate is going to look lower than a winter rate compared to right now. A 12-month rate should look higher than a summer rate because it depends what months are included. So you can just use the monthly bar chart to show, yeah, clearly the summer rate's lower because it doesn't include the 3 highest months, December, January, February, if you want to count March for the 4th. And the exact opposite for ERCOT, now that everything is settled down a bit since Storm Uri, where the winter actually was the most expensive for a short period of time, summer's back to being the most expensive, and we just saw August take off for calendar year 24 and 25 and a touch for 26. So again, except for ERCOT Electric, the prices for balance 23 and calendar year 24 are all below the 52-week averages, in most cases at or close to the 52-week low. So very reasonable spot to pick up at least a piece of that and lock it in, or 100% of a client's load for smaller or medium clients. Bunch of examples this week. We expect the current administration to continue the Going Clean push. And the big issue is if it's not executed well, this could cause large issues, because if we lose the fossil fuel supply and shut it down, and then we can't make all these forecasts, whether China cuts us off or any of the other issues we've talked about, we won't be able to replace it in time. So that could leave us short supply, and at the same time, we're electrifying everything. So demand's going up. So we're losing supply and we're increasing demand. That's usually a recipe for upward pressure on prices. And lastly, talking about the other components and strategies really helps differentiate, talking about how to maximize capacity in renewables. I mean, renewables can be 30, 40% of a bill. Electricity sometimes only 40 to 50% of the actual bill, maybe 60%. Showing the importance to a client of why you want to talk about that. Now, capacity and renewables are usually a lot more important than the winter reliability, because that's usually only a couple mils compared to a much bigger part of the charge. So concentrating time on really what's going to matter to a client's wallet. Thank you all for attending. For any of our channel partners, please reach out to your account manager if you have any questions or want to